Hello, everyone, and thanks so much for joining us today. My name is Steve with the Snap Projections Customer Success Team, and I'm joined today as well by Anu and Lee, who will be in the GoToWebinar chat and filtering questions to us throughout today's session. You can go to the question box of the GoToWebinar portal by clicking on the question mark. If anyone can go there now and just let me know whether you can hear me okay and see the screen, that would be much appreciated, and then we'll be all set to get started. Awesome. Thanks, Robert. So today's session is going to be focused on the corporate life insurance module that we recently added to the Snap software. We will be recording today's session, so if you have to step out for any reason, or if you want to come back and revisit any of the topics later in more detail, you will have that resource available. We'll send the recording to everyone who signed up for the webinar, and we'll also post it to our help site, which I'll show later on in the session. We're going to be building a plan right from scratch today, showing all of the data input. We're going to show how to add a corporation to your plan, how to input a corporate-owned life insurance policy. We'll discuss the new options and calculations for corporate dispositions and the personal estate values that result from those calculations upon death. And then we'll compare a couple different strategies using corporate life insurance in the software so that you can help your clients to make decisions about what to do going forward. We'll have a common use case for the corporate life insurance feature, and then we'll move on to some more advanced or rarer cases just to show some of the flexibility of how you can use the feature in the software. And then we'll finish up with a question and answer period. Please feel free to submit your questions throughout the webinar. We'll pause occasionally and tackle some of the questions that have come in related to specific sections of the software, and then we'll do more of a broad topic at the end. If we can't get to your question live today, we will get back to you by email within the next few days, so feel free to submit your questions and we'll tackle them as we go. I mentioned earlier the help resources available to you through Snap. If you're in the software, you can click on Help in the top right corner and then click on Help Center. That's going to take you to a lot of our articles, our old webinars that we've done, and then a lot of resources available like client questionnaires, sample plans, and things to help you build plans faster in Snap. You can also access our contact information, so our toll-free number and our email. So you can click on contact and send us an email directly with any questions related to your plans. We can access your plans with your permission, so you can always send details about a particular projection that you're working on, and we can take a look and help answer your questions. With that, we'll jump into the Snap software and start creating our plan for today. So I'll click Add New Client, and we're going to be creating a plan for Marco Lee, who was born in 1961, currently residing in Ontario, and he has a wife, Alice Lee, also born in 1961. Now that we've input the client data, I'll click Next, and we're going to progress through our scenario setup pages on the left here. The first one is the General Settings page. We're going to start the year in our current calendar year of 2023. We're going to assume that Marco and Alice both retire at age 65, and we're going to run the projection until they're age 100. If we click this teal blue button at the top, it's going to import the FP Canada guideline assumptions for inflation rates and rates of return. I'm going to make a few adjustments to these values in order to reduce them to a net of fee expected rate of return. Click Next and input Marco's salary of $90,000. That's coded as employment income in the software, so it's going to automatically deduct CPP and EI, and then it's going to tax it appropriately and earn additional RSP room. I'll click on Alice's name in the top left here, and I'll input her salary of $105,000, also coded as employment income. We can add additional income if we want, such as rental or inheritances in the future, things like that. But for now, we'll just keep it simple at their two employment income entries. On the left, we can see the next page is going to be assets, so I'll click Next. We have a default non-registered account that's added to each plan. This is both to show how to input a capital asset and also to serve as a catch bucket in case there's excess cash flow in a future year. So Snap would automatically deposit it into this non-registered account. Now I'm just going to remove that from this projection because I'm going to add a non-reg of their own. So Alice currently has a non-registered account of 50,000, and that's invested as 40% fixed income and 60% equity. She also has a tax-free savings account worth $80,000. And she has a DCPP with 330,000. So we've added the 3 accounts for Alice. We can go to the top left and click on Marco's name in order to do the same for him. We'll remove the default account, and then we'll add a non-registered for 25,000. A TFSA for 80,000. And an RSP for 220,000. We'll also come down to the add real asset section, and we'll click to add their home, which is currently worth 800,000. And their original cost base is 550,000. And then we'll set that as a joint asset, so it'll reflect half on each of their planning pages. I'll click next, and that'll take me down to the debts page. They don't have any mortgage or outstanding loans, so we'll leave this blank and click next to go to the government benefits page. By default, SNAP assumes that the client is going to receive the national average CPP benefit, which is 55% of the maximum. Because Alice and Marco are both earning above the YMPE and have had a stable employment history, we're going to increase this to 80%. So I've done that now for Marco, and then I'm going to click Alice's name and make that same change for her. So now we're assuming that they're going to start CPP at 65 and receive 80% of the expected maximum in that year. And then for OAS, we're going to assume that they both are going to receive the full benefit once they start receiving it. And just like that, we've set up the personal side of the plan for Marco and Alice. We do have the option to input personal insurance policies, conduct life needs analysis, add an RESP or a corporation. We're going to hold off for now before adding the corporation. And then we have lots of settings that we can customize if needed, but those are optional and in order to make the plan a bit more refined if the client situation calls for it. I'll click planning pages in the top left corner in order to go to the review page. So this is where all of that information that we just input comes together, and we can see both Marco and Alice's financial life all on one page. We start in 2023, and then the projection goes all the way down to the age 100. I'm going to click on Marco's name so that we can finalize his personal settings. For his employment income, I can actually come to the 90,000 in the first year and assume that that's going to index over time at the rate of inflation. So I'll copy that down, and we'll see that that employment income has now updated. He's also currently maxing out his tax-free savings account. So I'll go to the TFSA contribution column and copy down 6,500 until he retires. And he's contributing 10,000 per year into the RRSP. Now we can see on the planning page that when we make a change, the run scenario button turns red. And this is telling us that even though we've made a change in the software, it hasn't recalculated all of the follow-on as a result of those changes. So rather than constantly moving the numbers on you in the software, we wait for you to click run scenario, which is essentially like clicking refresh or apply changes. So now that I've hit run scenario, all of those numbers will flow through the plan and the calculations will update. And then we can see run scenario is now green, which means that we don't need to click it. Everything's up to date. I'll move to Alice's side of the plan and make similar adjustments here. So clicking on the first year of employment income, indexing it for inflation, and then maxing out the tax-free savings account for the next 3 years. And now we can go to the combined page and start to get a sense of where Marco and Alice are currently at in their finances. They're earning about $187,000 a year of taxable income after we've deducted the $10,000 RSP contribution. They're paying about $38,000 in taxes, and then they're both maxing out their tax-free savings account. And that leaves them with spending cash flow of about $125,000 per year. As we go down to 2026, when they're both expected to retire, we need to input their expected spending need. So they do expect to reduce their lifestyle spending requirement slightly, and they're looking for $105,000 per year of real spending. So we're going to input that and then click Run Scenario. Snap will automatically take our reference value of $105,000 today, and it will index that forward for inflation and input the actual amount of spending that Marco and Alice are going to need to do in order to achieve that same lifestyle on an ongoing basis. With just the personal assets input, we can see that they're expected to run out of money at age 76. The non-registered gets used up, then the tax-free savings account is depleted, then the registered account is withdrawn from. They do have a bit of money left in the locked-in account, but they can't withdraw more than the annual maximum, which means that they start having cash flow issues at 76. We can also see this visually by clicking on charts in the top right and looking at the eventual buildup of the pink debt that builds up in the projection in order to maintain that lifestyle of $105,000 a year. If we scroll to the after-tax spending, we can see that starting at age 76, roughly half of their desired spending is unfunded and is currently in a shortfall. So now we'll want to add their corporation. And you can do this in Snap if you're on the Advisor Business subscription plan. So we do have two offerings within Snap. We have the Advisor Professional plan and then the Advisor Business option. You can upgrade to the Advisor Business if you're not already on that plan, either by clicking Add Corporation and then accepting the upgrade prompt on the next screen, or you can go to your initials in the top right and go to Billing Settings in order to update the subscription that you're on. Once you're on the Advisor Business plan, you can click Add Corporation, and then we'll be prompted with the input fields, very similar to what we just went through for Marco and Alice individually. So in this case, I'm going to enter their holding company. As an important note, you don't have to enter the holding company and operating company separately in Snap. You can input all of the corporate information into one single entity, and Snap will automatically tax the active business income separately from the investment income. It's also advantageous to do it this way because Snap will automatically reduce the small business deduction value if there's more than $50,000 of passive investment income in a year. And any GRIP balance, RDTOH balance, things like that, that is being earned by the operating business is going to be added to the corporate balances and used in the future when you pay out dividends from the holding company. So we always recommend to model your corporations as a single entity so that all of that data can flow back and forth appropriately. We're going to leave the small business deductions as they are defaulted. If we wanted to, we could customize those for unique client situations. For the refundable dividend tax on hand, I'm going to input $50,000 as their starting balance. These numbers can often be received either from the client themselves or from their accountant. We do have a client questionnaire. Again, if you go to Help and then Help Center, we can go to Start Here and then Financial Planning Questionnaire. And we'll see that we have a short financial planning questionnaire that's useful for the majority of client files, and then a long one that includes gathering data for corporations. So if you want to gather all of those additional fields, you can use that form. However, it's not required in order to create a plan in Snap. So all of these balances like the RDTOH and CDA balance are just additional tax advantages that the corporation would receive in the future. If you leave them as zero, you're just creating a slightly more conservative projection, and you could always add them in the future if you wanted to update the plan later. So I'll input 50,000 for the RDTOH balance and then 25,000 for the capital dividend. There's no general rate income pool at the moment for this corporation, and their ownership structure is a 50-50 split. So I'll just make that change here. That brings us to the disposition section of Snap. So this is one of the major updates that we've made with this release. Previously in Snap projections, there was only a single disposition option for the estate calculation, and it was referred to as the share sale option. What we did was we took the net worth of the corporation in the final year of the plan, and we assume that that was the sale price of the corporate shares that were owned personally. And so there was a capital gain realized by the estate for the amount of the net worth of the corporation, less any adjusted cost base that had been input for the shares. With this release, we've added a second method called winding up, which instead of selling the corporate shares themselves, this method assumes that the corporation liquidates everything that it owns, repays any debt, and then distributes the cash to the estate through either return of capital, capital dividend, eligible dividends, or non-eligible dividends. So it's an alternative way to model the wind down of the corporation. This is the new default method that will be turned on in Snap. So when you create a new plan and add a corporation, the method for disposition will default to winding up. It's also the method required in order to add corporate life insurance to a plan. The main advantage to using winding up is that it takes into consideration the corporate, the notional account balances, like the GRIP balance, the CDA, and the RDTOH balance that has been tracked throughout the projection. So even if you start off with 0 for all of those values, Snap is still going to calculate and track the expected future GRIP, CDA, and eligible dividend balances, or RDTOH balances. And so using winding up is going to be a fairer way to compare different strategies while taking into consideration those notional account balances. But of course, if you want, you can always go back to the original default, which was the share sale option. We'll also go through a estate calculation in detail as we finish up this plan, but for now, we'll move on to the assets page and input the existing investments for the holding company. So we'll click Add Capital Asset, we'll add investments, current value of $2 million, and an original cost base of $1.75 million. There's no debts, insurance, or other settings to adjust for the corporation at the moment, so I'm going to click Planning page. We can see that the investment account is tracked each year of the plan. Snap automatically withdraws enough money from the investment in order to pay the expected annual taxes on the investment income, but otherwise the account is just assumed to grow throughout the projection. We can come down to age 65 when they're both set to retire, and they're planning to take $25,000 a year in non-eligible dividends and increase that over time at the rate of inflation. So we can input both of those dividends, one for Marco, one for Alice, and then we'll click Run Corporation to apply that change. Now we can see that Snap is withdrawing enough to pay both the dividends and the taxes. We can also see that the taxes have dropped because we're now receiving dividend refund credits as a result of paying out the non-eligible dividends. So Snap automatically calculates all of that and then withdraws the required amount from the investment balance. As we get to the final year of the plan, we can see that there's expected to be about $2.4 million left in the corporation. If we go back to the combined planning page for a moment, we'll scroll down to see whether that dividend level of $50,000 a year, $25,000 each, is going to be enough to sustain them. And as we get to the bottom of the plan, we can see there's no shortfall. All of the $105,000 a year spending is funded, and there's a balance left over of about $869,000. We can revisit those charts from earlier. We see that there's no pink shading, no debt building up throughout the projection, just a tracking of their corporate, real asset, and personal liquid assets throughout the plan. And then the spending is fully funded throughout the projection. So that's our scenario 1, which we'll just call base case. So this is kind of where they're at right now. And we'll do some analysis to see whether there are other options available for Marco and Alice to consider. But before I move on, I just want to pause there and check in with Lee and Anu to see whether any questions have come in so far.
Yeah, thanks. Thanks, Steve. One of the questions is just to find out more about the winding up and how that works, how the disposition works. But I know you're going to go into that further. So just to let people know that that's coming.
Yeah, we'll get to that within about 10 minutes once we create the second plan, and we'll start comparing what the wind-up numbers look like in different plans. What I can do for now is I can come down to the estate before tax in the final year of the plan. So with this current base case, they do expect to have about $5 million left over at the end of the plan. And that's made up of 800,000 of personal capital assets, 1.8 million of their home, and then 2.3 million that we saw in the corporation. And if I hover my mouse over top of the corporation, we can see what the expected distribution method is going to be. It's going to be 962,000 of capital dividends, 541,000 of eligible dividends, and then the remainder 831,000 in non-eligible dividends. That's going to all result in a $5 million estate before tax, a $500,000 tax bill, and then a net estate of 4.5 million. So with so much excess projected in the plan above what they need for spending purposes, Alice and Marco are wondering whether there may be a more efficient way to pass some of their wealth on to their beneficiaries. So we're going to create a second projection. So I'll copy this scenario and just call it scenario 2 corporate insurance. And then I'll click on the holding company in the top left and then go to scenario setup and insurance. And then I can click add insurance policy. I'll just call this corporate policy. For the type, I'll choose whole life. For the insured, with SNAP, we follow a very similar process to the personal side where we currently need to indicate a single individual in the plan who's the insured party. If it's a joint policy, then you would pick the individual that aligns with the timing of the expected payout. So if it's a joint first to die policy, you would pick the person that is projected to pass away first in the plan. If it's a joint last to die policy, you would pick the person that's going to pass away last. And if they both pass away in the same year, which is the case for our current plan, then you can pick either individual for the insured. So I'm going to pick Marco in this case, since they both pass away in the same year. We'll then come to the death benefit and annual premium and click on edit in order to bring up the policy input table. Now, one of the great things with SNAP is that you can actually just copy and paste these values into the software. So I've gone to my quote provider, I've copied the expected death benefit, cash surrender value, adjusted cost base, and annual premium, and then I can just click Control V and paste those values into the SNAP software. So now we have the death benefit over time, we have the cash surrender value, the adjusted cost base, and the annual premium. I'll go back to the planning pages to see how that policy now reflects in the projection. We have a section to the right of the capital asset now for the insurance. And we have, again, the death benefit, cash surrender value, and premium. And then if we hover our mouse over top of those values in any year, we can see a bit of a pop-up that says the year, the client's age, and the adjusted cost base of the policy. We can see that the withdrawal from the investment account has now increased. It's now paying both the income taxes and funding the premium for the year. So it does that. And then once the dividend payments start, we can see the withdrawal jumps up even more. It's now paying taxes, premium, and both dividends. So SNAP automatically takes care of all those calculations and automates the withdrawals accordingly. If we scroll down throughout the plan, we can see that now there's about 1.3 million left in the investment account, whereas before there was about 2.4. So we've just used up some of that money in the early stage by funding the premium for the insurance policy. And in the final year of the plan, we would expect to receive about 1.4 million from a death benefit, and the cash surrender value is about 963,000. So as we go to the right-hand side of the corporate planning page, we can see that there are two key columns. There's the net worth column. This is the value of the corporation, assuming that the client is still alive. So this is going to take our value of the capital assets plus the cash surrender value of the policy. That's the net worth of the corporation, assuming that we're continuing to operate and that the client is still alive. Then the column to the right is the after-tax estate value. This is how much cash is expected to be available for distribution to the estate if the clients were to pass away in that year. So we'll click on the 3.1 million and we can see how that breaks out. So this is the winding up method, kind of top to bottom, the calculation and the methodology that's used. So in the first year, we have 1.9 million of capital assets, and we have an insurance cash surrender value of 24,000. That brings us to a $2 million net worth. That's the same value that we see here in the first column. And then in order to calculate the taxes and expected distributions to the estate, we first assume that everything gets liquidated in the corporation. So that would result in a tax on disposition of about 65,000. So that's just the unrealized gain on the capital asset in the corporation. Then we do a calculation to figure out how much is going to be distributed from the corporation and how much refund is going to be received from the RDTOH balances. And we add that to the net worth of the corporation in order to arrive at a market value for tax calculation purposes. This $2.06 million market value is what's used for an initial tax calculation. What gets assumed is that the corporation was essentially sold for this amount. The shares of the corporation were sold for 2.06 million, and there was a capital gain realized by the estate for that value less the adjusted cost base that was entered on the scenario setup. In our case, we left that as 0. Then what happens is with that capital gain, we can offset a portion or all of that capital gain by paying out distributions later on from the cash. So we're not always going to end up paying a capital gain tax. It's just an initial calculation that occurs. And then if we can offset it through dividends, it'll often go away and we'll just pay taxes on the dividend distributions in this method. Once we have the market value, we remove the insurance CSV since that's not actually being received in the event of death, and we add in the insurance proceeds. And that gives us our total cash that's available in the corporation for distribution to the estate. And then SNAP looks at the available balances, so any return of capital that could be paid, any capital dividends. It looks at GRIP and RDTOH balances in order to determine how much eligible and non-eligible dividends to pay. It makes those distributions and then it offsets as much of the capital gain from the initial calculation as it can. So there is a rule called the stop loss rule that no more than 50% of the original capital gain can be offset through capital dividends. So even though we're paying 1.2 million in capital dividends in this case, only half of this value can be offset through that capital dividend, but we don't have to worry in this case because we're paying an additional almost 2 million in taxable dividends, and all of those go to offset the capital gain. So in this case, we'll have no capital gain in the final estate. It'll just be taxes on these two distributions. I'll click close and go to the final year of the plan. And we'll kind of run through that calculation once more with different numbers. So in this case, we're expected to have a $1.2 million capital asset balance in the final year of the corporation and a insurance CSV of 900,000, which brings us to a net worth of 2.2 million. We do the same adjustment again, assuming that we liquidate all of the investments and then that we're getting a refund for the distributions that we're going to make. And that gives us our market value, which creates an initial capital gain. Then we remove the insurance CSV because we're not receiving that. Instead, we're getting the insurance proceeds. We have 2.7 million available for distribution, and that's going to be paid out as 2.2 million in capital dividends, 374,000 in eligible dividends, and 122,000 in non-eligible dividends. What we can see here is that we can only offset half of this initial capital gain through the capital dividend payment. So we're going to reduce our starting capital gain from 2.2 million to 1.1 million. And then we'll further reduce it by another 500,000. So we'll go from about 1.1 down to 600,000 that we're still going to have to pay as a capital gain in the final estate. And we'll see that once we go to the personal side of the plan. So that's the calculation for the distribution methodology. I'll close out of here and then go to the combined page so that we can see what the personal estate is going to pay. So if we go to the final year and click on the 5.38 million, we can hover our mouse over top of the corporation And we can see those same values that were on the previous page. So 2.2 million being paid as a capital dividend, 374,000 as an eligible dividend, 122,000 as a non-eligible dividend, and then that leaves 614,000 as a capital gain that the estate would still have to pay taxes on. However, because we're getting so much of the money out through capital dividends, the tax on estate is still quite low. If we click compare with other scenarios, we can see how this scenario compares to our original plan without the insurance policy included. So in both cases, this is the final year of the plan, so 2061. We're expected to have the same amount of personal assets in both of those plans. The only difference really is on the corporation front. So with the life insurance, we're expecting about $400,000 more because we've received the death benefit in the final year of the plan. And then we've also reduced the tax bill by about $250,000 by distributing a lot of that money through capital dividend. If we go back to the corporation in this plan, we can see that it's primarily distributed through eligible and non-eligible dividends that are all taxable. So in the end, adding the corporate life insurance policy in this particular client case has increased the net worth by about $600,000 after tax. So that would just be additional money available for their beneficiaries if they were to pass away in this particular year and if everything else in the projection went as planned. So we've been able to demonstrate to Alice and Marco that there may be some value in taking out a corporate life insurance policy. Before they go ahead with the transaction, they did want to run a couple additional scenarios just to see what might happen if they buy the policy and then run into some unexpected increased spending or life expectancy changes. But before I run into or start those two next scenarios, I'll just pause and see if there's any other questions that have come in just yet.
Thanks, Steve. Am I on mute? Sorry, just checking. No, okay.
No, you're good.
Just one question about, does SNAP take into account the lifetime capital gains exemption?
So it's not automated within SNAP just because it may or may not apply depending on whether the client has already claimed it in the past. The way that you can request to include that is when we're setting up the corporation. So if we go to planning pages and then the holding company, if we go to scenario setup and then holding company, if we go to the adjusted cost base of the shares, this is where you can input your expected lifetime capital gains exemption that would apply to the transaction when they pass away. So that's how you can offset some of the capital gains that would be, taken care of by claiming the lifetime capital gains exemption. And if you have more questions about a specific case and how those numbers would apply, you can certainly reach out to us and we can chat further. But this adjusted cost base is the way that you would adjust the plan for that tax consideration.
Great. And we just had a quick question about, is there a difference here between the UL policy and whole life?
Yeah. So the only difference between a whole life and UL in SNAP is if I add a universal life policy, I'll have the option to include the cash surrender value as part of the death benefit. So if it's a policy that will pay both the cash surrender value and the death benefit, then I can check this box in a universal life policy in order to enable that. But otherwise, the logic for the two policies is the same if this box is left unchecked. Awesome. So I'll finish up with the last couple examples and then we can open it right up for questions at the end. What I'll do is go to the top of the plan where I currently have scenario 2, corporate insurance, and I'm going to copy this projection. And then we're going to call this scenario 3, policy loan. And Alice and Marco are wondering what happens in the future if, say, at age 85 on their planning page for the combined couple, if their expenses increased from $105,000 a year to $160,000, either for medical purposes or some other unexpected spending increase need. What happens if they have those additional expenses? So we can run a scenario to show what options are available if the insurance policy has been taken out. So we see that with those increased expenses on the personal side, they now run out of money at age 92, given the current distributions from the corporation, and they build up about 1.4 million in debt by the end of the plan. So we can go into the holding company and then scroll down to the age 85 where they're expecting those increased expenses, and we'll bump up the dividend payments to 80,000 a year, and then we'll index those dividends going forward. So as of age 85, we've increased the dividend payments from the corporation, and then we'll click Run Corporation. And as we scroll down in the corporate plan, we can see that the investment balance now runs out of money with only a few years left in the plan. And SNAP calculates the shortfall and builds up a bit of a debt within the projection. So what we can do is we can add a policy loan and borrow against the cash surrender value in order to avoid illustrating running out of investment assets in the corporation. So I'll click Add Debt and call this policy loan. We'll have a $0 balance starting today because we're going to use this loan in the future. We'll enter in our expected future interest rate, and then we'll set the repayment options to interest only. Then I'll go back to the planning page and we'll be able to see that there's now a debt section added to the report. And I can scroll down to the future year, and at age 95, I could start to borrow against the policy by clicking on the amount paid column and then entering 125,000 per year and copying that down until age 100. So now we're going to start borrowing against the policy, and we're just going to want to make sure that that value doesn't outpace the cash surrender value in the plan. So now we can see borrowing 125,000 a year. We build up a total debt of about 892,000. We avoid running out of investment income or investment assets in the corporation. And when we go back to the combined view, we can scroll to the bottom and see that there's no longer any shortfalls. Those additional dividends have been enough to see them through the additional 15 years of higher expected expenses. So that's how you can use a policy loan to create income within the corporation in your plan. You could start this process in any given year. You could do it before they've even started drawing down on their investments, or you can wait until they've gone through a portion or all of their corporate investments. But the policy loan is how we would illustrate that income coming off of the corporate policy. I'll go back to the scenario 2 so that we can have a fresh scenario with the corporate insurance policy in place. And I'll once again copy this scenario. And then I'll update the title to scenario 4, income replacement. So another potential use case for corporate life insurance is instead of waiting until the final death in a projection and using the proceeds as part of an estate plan, you could use the corporate insurance policy in order to pay out if one spouse were to pass away early in the projection so that the death benefit could be used to supplement the surviving spouse's spending needs. So that's what we'll illustrate here. We're going to go to scenario setup and then general, and we'll change Marco's projected age of death to 85, and we'll leave Alice at 100. We can see that change on the planning page by going to the combined page, and we can scroll down and we'll see that now Marco's age is removed after 85, but Alice continues on in the plan. Now, when we remove someone from a projection, SNAP defaults to remove their spending requirement from the plan. If we want to assume that they're still going to need close to this spending level, we would just go to the last year and continue to copy it down so that we can assume that Alice is still going to need $105,000 a year of spending. And we can see that because Marco's government benefit income has been removed from the projection, Alice on her own would not be able to sustain that 105 spending level without additional distributions from the corporation. So we can go to the holding company, and then go back into scenario setup and insurance. So we haven't yet purchased the whole life policy, so the quote may change if we were to change the policy type, either from a joint last to die or an individual policy or a joint first to die. But in this case, they're wondering whether it would be worthwhile to have a policy that would pay out if Marco were to pass away early. So we're going to have Marco as the individual insured so that it pays out when he dies. And then we'll go to the planning page and we'll scroll down to the year that he's projected to pass away in 2047. There's a large deposit of the insurance death benefit into the asset base. And then we can use that later on in the plan to increase the dividends to Alice so that she doesn't run out of money. So at age 86 for Alice, we'll click on the dividend. We'll increase that to 100,000, copying that down and indexing it for inflation. And we can see that the balance of the investment account still remains quite healthy because we've replenished it, and the investment returns alone are almost enough to cover the expected dividend that's going to be required for Alice's spending needs. So this is another use case where we can use corporate life insurance to illustrate a payout during the plan and then use that money for various purposes. If we go to the notional account balances, which can be found by clicking on this blue box in the top right corner of the corporate planning page, we can see things like the GRIP, CDA, and eligible and non-eligible RDTOH balances throughout the projection. As we scroll down on the CDA balance, we'll see it jumps by the amount of the death benefit less the cost basis of the policy in the year of death. So we could use capital dividends to pay out from the corporation instead of using non-eligible dividends if we wanted to save on taxes during Alice's lifetime. So those are all options that we would have available, and we could choose, we could have another scenario where we illustrate the added benefit if we pay these out as capital dividends instead of non-eligible dividends. Once we're done with any of the plans that we want to ultimately present to the client, we can go to the client report section. There have been a few new pages added as a result of the corporate life insurance policy. So if we go to the corporation, we'll see there's an option to include the insurance policy details in the report. So that just has the death benefit, cash surrender value, adjusted cost base and premium each year. And then if we look at the net worth for the corporation, we can see that the insurance cash surrender value is included in the net worth value. So this is another change that we made with the most recent release. The cash surrender value of life insurance policies is now added both for personal and corporate policies to the net worth of that individual or corporation. With that, I'll kind of open it up for questions, and we'll see whether there's anything else that's come in during the session today.
Terrific. Thanks, Steve. I have a couple questions to ask. One about the loan. So we're illustrating here the loan may be coming from the bank and you're using the insurance policy as collateral. What if you're taking a loan directly from the insurance company?
So another option would be within our insurance policy setup. So if we go back into the policy details, in some cases, you might actually have a projected borrowing against the cash surrender value on a more formal basis. So you would update this cash surrender value to be the net of any borrowing value. So if we're expected to have borrowed, $900,000 by the end of this plan, then the true cash surrender value would be $63,107. So you could paste the expected cash surrender value from that insurance quote into this table. And in that case, what we would do is on the planning page, instead of adding the income as debt through a policy loan, we would instead add it as other income. So we would go to the other income column for the corporation, and we would pay $125,000 to the corporation to represent the cash flow from borrowing against the, or from withdrawing out of the cash surrender value through the insurance company themselves. So we would use other income, and then we would update the cash surrender value projected in each year of the plan.
Great. Okay, one of the big questions that we typically get, and we've had a few people ask today, is how could we get the money to go out to the personal side? Is there an automatic calculation that will tell us how much we need to provide in dividends? How did you come up with those numbers?
Yeah, so all of these, like the 25,000, the 80,000, those are manual calculations that are, there's a few different strategies that you can use in order to pay out dividends in your plan. If I start with a fresh projection, so I'll just go to our scenario 2 for a moment, or actually let me go all the way back to our base case, and I'll copy that and then go through some examples. So scenario 5. So a lot of the time with your dividend strategies, these values might be provided by the accountant or the client. They might know what their plan is in terms of when and how much income they're going to want to use out of their corporation. So in that case, you can plug in those values and just demonstrate how that would impact their plan. If we have those values, we can go back to things like Marco's planning page, for instance, and show that by taking 25,000 a year of non-eligible dividends, he's going to be below the OAS clawback threshold. His marginal tax rate is going to be fairly reasonable. So you can use key numbers throughout the plan in order to determine what an appropriate dividend level might be. If we remove the dividends altogether, if I just go back to 0, we saw that they were running out of money in their personal side around age 76. So if we go to combined, we see that they run out of personal money around age 76. So we know that we have to turn on the corporation dividend payments at some point before that in the plan, or else they're going to run into cash flow issues. So then it becomes a question about, well, where do they have low taxable income? What sort of, fees or balances do they have in the corporation itself? Several rules of thumb that I've used in the past with clients and that I've seen work quite well. If you want to just assume that they're going to take out the investment growth from the corporation, you can start there. So that would be basically taking the rate of return times the value of the corporation and then paying out that amount from the corporation. So that's where the 50,000 kind of came from. So 25,000, copying that down. Oops, and indexing it. So you can use things like the growth of the investment account. You could also choose to try to pay out the corporation by a specific age. So if you want to deplete the corporation by age 80, then what we could do is come in and pay out $100,000 a year, copy that down and index it. And then run the corporation, and then we'll see that it gets, in this case, the balance is about 200,000 as of age 75. So we're depleting it a bit faster than intended. So we would just reduce these non-eligible dividends from there. So at the moment with SNAP, it is a bit of a calculation and iteration in order to find the strategy that you'd like to illustrate within the plan. It is something on our radar for further automation, but because there are so many different strategies, there's client preferences, there's what the accountant might recommend. Even just starting with an illustration of draining everything out of the corporation through non-eligible dividends will give you a good starting point for discussion. And then you can kind of build from there if you want to model any different drawdown strategies.
Terrific. Thanks, Steve. And we just had also a question about when you were trying to figure out the loan, how did you figure that out? Or is there a way to, find out what would the best loan amount be in this projection?
Yeah, so that as well was a bit of calculations to, so what I did was, if I clear out the loan, we know that in total, there's going to be about $800,000 of borrowing required at minimum in order to avoid running out of investments. We also know that the cash flow challenge starts around age 95, 96. So I just went to kind of age 95. There's 6 years here of borrowing that we can do, and we're going to need about 800,000 total to be borrowed, plus the interest that would be capitalized on the debt. And that's where the 125 figure comes from. So we're just kind of using reference values in the plan in order to approximate a value, and then we would run the corporation and see whether that achieves the, oh, so I entered a positive value there. So entering negative 125,000, and then we would see whether that illustrates what we're trying to show in the projection. If I had put, more than that, if I put negative 200,000, for instance, from that age on, we're going to see that it's more money than we need. So that's not ideal. We still have 500,000 left in the investment account. And then the balance of the debt is also higher than the cash surrender value. So we don't want to illustrate that either. So it is currently a bit of a iterative process in order to find the right level of borrowing against the policy in order to illustrate what we're trying to show. It is something that we're interested in expanding in future releases of the corporate insurance module. So if you have common use cases for policy loans, please reach out to us and let us know kind of what you would ideally see in the software to automate any of that process for you. A lot of these feature enhancements are done as a result of client feedback, and we did a lot of collaboration with existing users to develop this first implementation of the corporate life insurance. So hopefully it meets a lot of the common use cases, and we'll continue to expand it going forward.
Thanks, Steve. One other thing is there is no term option right now for the corporate insurance. We just had a question, how would you enter term insurance?
Yeah, so if we wanted to model a term policy, and it kind of comes back to when we started brainstorming and meeting with existing Snap users to develop this initial corporate insurance module, term insurance was a fairly rare case. And so we haven't explicitly built it into the software as a type or as a policy type, but you can still illustrate a term policy using the whole life module. So you would add a whole life policy. We would link it to, let's say, Alice's name in this case. And then when we click on the death benefit edit field, we would just run the death benefit for the term of the policy. So if it's going to be $1 million term policy until the client's age 70, then we would just copy this down until 2031. So we would copy down to 2031. And now we just have the death benefit for the relevant term of the insurance policy. And then we would add any premium for that same period. So copy it down to 2031. And now we have our term policy. So when we go to the planning page, we have the corporate policy. We can title the description of the policy as term policy, and then in notes in the client report, we can also clarify that it is a term policy. But in terms of the calculations and numbers themselves, this achieves that outcome.
And then that policy really is only going to affect the personal projections if this person passes away, if the second person in this case passes away before that time.
During that
term
period,
ends.
exactly. Yeah,
Right.
so we can see the calculations for estate drops off once the policy term ends. And if we go to the combined page, we can similarly see that in the 2032, once the policy term is over, their projected estate drops by $1 million, the amount of that death benefit. So it acts exactly like a term policy in the software. If term policies are something that you're interacting with regularly and you have any other questions or feedback for the feature, please reach out to us. You can find our contact information in the help article site, toll-free number, and then you can click contact to send us an email and we'll get back to you there as well.
I don't know, Steve, if you actually showed any of the charts that, the net worth chart, for example, and how the cash surrender value is now on that chart.
Yeah, so because we were primarily within the holding company for the insurance policies, I haven't been able to show that the CSV is reflected in the net worth chart. But if we add, let's just do that here. If we add a personal insurance policy, if we do a whole life, so now we've got our death benefit, cash surrender value, and annual premium for a personal policy. And then if we go back to the planning page and look at the chart for net worth, we can now see there's this pink line in the middle for the cash surrender value of the insurance policy. So we have insurance now added to the projection. If you hover your mouse, it'll focus on that. And then we can also remove any values from the chart if we just want to focus on specific sections of the client's value. So if we just want to talk kind of about liquid investments and the insurance cash surrender value, we can focus the conversation there. If we want to include everything and talk about their total net worth, we can enable or disable anything from the chart. But that's where the CSV is now included. And then it's also, of course, included in any of the tables throughout the client report. So if we go to client report and then the net worth projection, the net worth is now including the total insurance cash surrender value. So total insurance, and then that's included in the net worth of the individual.
And we do have a few other maybe more in-depth questions that we'll get back to you as soon as we can by email or phone after the webinar if we didn't get a chance to answer your question. So I just wanted to mention that as well.
Mm-hmm. Awesome. And I'll just mention a couple other resources. If you are interested in learning more about the different plans with Snap Projections, you can go to snapprojections.com. And then we have our plans and pricing tab. It just explains the difference between the advisor professional and advisor business subscriptions that I mentioned today, and then also outlines the annual pricing savings if you ever want to switch to that subscription option. If you're in our help site, we also have our ongoing Q&A periods. So if you want to drop in to a bi-weekly session, you can come to the product walkthrough and Q&A section, and you can register for the next upcoming event will be March 15th. And you can also check out recordings for any of the sessions if there's a particular topic that's of interest to you. And that's all, of course, on top of the historical webinars that we have recordings for, and then the articles. So for the corporate module that we just enhanced, if you go to the corporations and businesses section of the help site, you'll see there's an in-depth article on corporate-owned life insurance. It has some use cases and calculations and whatnot if you want to review that in more detail. And then there's the corporate disposition on death, which talks about the share sale and winding up methods and how those get applied to the plan. But of course, with the new feature, please do reach out to us with any feedback, good or bad. Let us know what's great about the new experience and what's working well so that we can make sure that that remains in place. And let us know if there's anything that you would love to see enhanced, and we will let our product development team know. Awesome. But with that, we've got about a minute left, so we'll let you all go a bit early. Really appreciate you joining us today and continuing to use Snap as your financial planning software. If you have any questions, reach out to us directly. And if we haven't been able to get back to your questions today, we'll send you an email within the next couple of days. Thanks so much and take care.
Thanks, everybody.